Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Peterson.
Thank you for joining the Real Estate Risk Report. I'm your host, as always, Lance Peterson. Thank you for joining us. So today I have with me Hillary Seiler. She is with Financial Footwork. She's also based in, coincidentally, in Portland, Oregon, as am I. So happy to have her on the show. How are you doing today, Hillary?
Doing amazing. Thank you for having me.
Yeah, you're welcome. So this is one of those episodes where we're going to pan out a bit, kind of get out of the weeds. We spent a lot of time talking about specific, property types and strategies and really hearing from, many of the active investors, which I think is instructive to kind of see the differences between, how different people look at things and, what their investment philosophies are and why they're bullish on certain property types or, asset classes or markets and things like that. But today we're going to spend a little bit of time just talking about how, you should kind of look at constructing your portfolio. We have several guests on to kind of talk about those sorts of concepts, but it's always good to get, sort of differing, viewpoints. I think that some of the confusion out in the market is that, hey, it's a 60-40, stocks and bonds and, things like that, I think is sort of the times are changing. And I think a lot of it's just being driven by access that exists today that maybe didn't before, right? So, which was sort of driving some of that thinking. But before we get into all that stuff, Hillary, why don't you share with us sort of, how you ended up developing interest in this business and working and educating people on, really attaining, their own financial freedom and just, managing their finances and those sorts of things. So what kind of drew you to it?
I grew up in a financial household, actually. So my father and my mother were both in finance. And I was around and hearing about money all the time, and it fascinated me. And so as I was growing up, money was always a topic of conversation. I did have a job all through high school, so my dad really drove home the value of a dollar, how to earn it and why it's important. And then after college, I had some stuff happen in college. My mom got very ill. We had a good amount of money saved for my college education. I was set, and by my sophomore year in college, I had no money for my college education. I was taking out student loans. I was working full time. And I really just understood at that point in my life that money comes and goes very quickly, and that if you're not prepared for it, when you're not prepared for when life happens, you can really, pardon the expression, fall on your ass. And at 19, I learned that the hard way. And that was when I realized I never wanted to feel that way again. And I also really wanted to help people understand their financial picture, because I was going through this tough time, and I had friends that they had it fairly easy. They were on scholarship in college, so they had, $1,500 check coming in every month. They had $1,000 of discretionary income, and they were just blowing it. And I couldn't rub two pennies together to buy coffee. And that was the moment I realized it's not how much money you have, it's how you manage the money you do have. And as I went through college, I met some really good friends of mine that ended up drafted in the NFL. And I decided to help them when they asked me to. I made the conscious decision to work with them on their money. And that is how I landed the role of financial education for the NFL, and then started my own company, my second company, Financial Footwork, to help consumers, because athletes are wonderful. I love working with them, but everyone needs help with money, because it's one of the three things we think about every day. So that's what really landed me where I am today, teaching financial education. It's all about helping people and hoping that no one has to end up in a situation where I lived. I lived in a not so good financial situation for 7 years.
Yeah. So then with that said, I mean, what are the sort of, where do people begin? I mean, in the case of a professional athlete, they go from probably similar, can't rub two pennies together to buy some coffee, to, yep, oh my gosh, I have more money than I ever could have imagined. And most of us are sort of, you kind of, the paycheck to paycheck, you're trying to figure out how to break out of that and, live below your means and save and sort of, but I'm assuming in both cases there are sort of some core tenets that you believe in, or your own kind of philosophy that you impart on people. Maybe share kind of that high level framework and and to set the stage?
Absolutely. I think it all starts with a budget. You'll probably hear everybody say that, but the reality is, I believe the last stat I saw is over 70% of American households don't use or have a budget, which is crazy to me because if you're not using a budget, how do you know where your money's going? And I say it to my athletes, but I also say it to all of my clients. If you can't manage $100, you can't manage $1,000,000. Because if you don't know where the money is going and you're not tracking it, you're not building wealth. And so in my opinion, everything goes back to your budget because your budget sets the stage for how you save, how you pay off debt if you have it, and then how you set long-term goals. And again, goals don't have to be 20 years out. You could have a 3-year goal to buy a property. You could have a 3-year goal to invest $100,000 in different stocks and bonds. So all of that stems from how you handle your day-to-day finances. What are you doing every single day to save, to manage, to hit your goals? And it all starts with your budget. Professional athletes, people like you and I, it all starts with a budget. And that is the foundation or fundamentals of where your money starts and ends every single day.
Yeah. And so are there certain tools out there these days that you have found to make that easier? Or are you still sort of like that go get cash, get 6 different envelopes and put it in there and spend it till, you run out of it?
Honestly, I think it's by the person. So I'll give you 3 examples. People that work in cash industries, right? Let's say I'm going to use tattoo artists for examples because it's a very cash intensive industry, but there's a lot of money in it. They're operating in thousands of dollars in cash. They do need a cash envelope system because it's just easier for them to manage. Same with servers. Again, a very cash intensive industry. So yeah, I would say for those types of people that are operating in cash and not going to the bank all the time, the cash envelope system is a great way to manage your money. But I wouldn't encourage that in life for everyone because there's only a small percentage of the population that can benefit from that. And also, cash is easily lost. If someone steals it, there's no way to get it back. It's not protected against fraud, all of those different things. Now, it is protected in the sense that you didn't get your debit card stolen, but someone breaks into your house and all your cash is gone, you're kind of screwed. I will say that is one very small portion of the population. The next is people that are using multiple bank accounts. Have you heard this system? Do you know what I'm talking about?
I'm sure I have, but yeah.
Yeah, so the multiple bank account system, I actually do a combination of all of these, but it's where you have a bank account for all of your different funds, whether that's a sinking fund for housing expenses or a long-term fund to buy a new car or a house. And what you're doing is you have 25 bank accounts and you're moving money in every time you get paid. And then it also goes in to pay household expenses, rent, monthly bills, all that good stuff. And so what people will end up doing with multiple account situation is that's how they budget. That's how they're tracking their pots of money. Now there's also the traditional way, handwritten budget. I mean, that's personally what I do because it allows me to see what I'm doing and it also keeps my spending in check. And then I have people who use online apps like Personal Capital or Mint.com where they have it do that for them. There's so many platforms out there and it's kind of pick your poison. Which one do you like? Which one don't you like? Why do you like it? I have clients all over the board and they all like different software based on what that software can do. So if you need something that just puts it into a pie chart and tells you how you're spending, the online apps are a great way to go. So there's a lot of different ways to budget. And I think that's actually helpful because it did not used to be the case. Being able to pick how you want to manage your money is powerful. You can choose, okay, I'm going to watch all of these items on my online banking, or I'm going to write out what I spend because I have a spending problem. And if I'm writing it down, I'm less likely to spend. And I have about 30% of my clients that do that. They still do a handwritten budget because it really keeps that discipline in check. And money is not, anyone who says money isn't about discipline, that's 90% of the battle, in my opinion. It's can you control the impulse buy? Can you track your spending?
Yep.
Yeah.
So when you get that down, you start to build some wealth, right? And I think in the case of many of our listeners are, I think they've figured out how to do it, right? They probably use budgets, whatever, one way or another. They've figured out how to accumulate some wealth. They made those investments. Now they're trying to figure out, how do we best put those resources to work, right? Because now once you have saved up and you've gotten yourself to that position, in our case, every day we're talking about sort of alternative investments, in particular, sort of real estate investing, passively. And I'm assuming too that I'm interested to get your kind of take on professional athletes, because I feel like that's, they do have that, they end up with that problem where there's just way more cash. Where do I put this? Who do I trust? All that stuff is in play because everyone knows, hey, I saw the contract you signed, and they're hitting them up. And so, I feel bad for them more than anyone because people know who they are and they're hitting them up. But the same principles apply, is that ultimately you've got to say, how do I get this? Because a professional athlete or an NFL player especially, they've got a pretty short shelf life. Their earning potential with that particular occupation is, if they can go 10 years, that's amazing.
Yeah, I think it's 7 years. That's incredible.
Yeah, that's right. You're a running back or something. It's like, man, you're just, it's like they just run you into the ground for, 2 or 3 years and you're out. So, they've got a bunch of it right there and it's right in front of them. So how do you look at that? Like, okay, we've got money to work with, whether you got it all and, pretty quick and now you're just, flush with cash, or you've got, you've accumulated over time and you're trying to figure out how to allocate it. How do you begin to consult and educate, like, how to think about that? Like,
so
how should they look at the totality of this portfolio they have?
Right. And we do take an education approach. I think you said it best. We don't look at it from just an investment or just a stock portfolio or just a bond portfolio or just a real estate portfolio. We look at it from what tools do you have available to you to grow your pot. And the ongoing joke in the NFL is protect your chicken. And that basically just means your pot of money is your chicken. And if you cut off one of the legs, you've killed your chicken. You're not going to be living off that bad boy for very long. But if you feed it, even if it's just a little bit every month, and you eat off the eggs, you're not only fattening your chicken, but you're giving yourself better eggs. And that's kind of the analogy that we use for our guys. And I actually had one player this year tell me about his cow and the milk, right? It's the same concept. It was really funny. We were sitting there laughing with the Miami Dolphins and just cracking up. But what we tell them is you've come into cash quickly. And for those of us who've accumulated it for a long time, it's the same fear. We don't want to lose it. Yeah. That's the fear. And it's how do we put it into multiple avenues to not lose it? And that is the education piece that we focus on. And so we focus on all the avenues. We focus on an investment portfolio, diversified. We also focus on upcoming and incoming tech world. Venture capitalism is really what I'm getting at.
Yep.
We look at venture capitalism and what's happening with private equity companies. And so we're looking at higher end investments and then your basic investment portfolios. Then we're also looking at the real estate avenue of things, which of course we can dive into heavily because that's one that most people want to go through. Then we have alternative investments, NFTs, art. We could be looking at a car collection. I actually have a current player who is huge into old cars. His collection is massive now. That is considered an investment. It is considered something that he could potentially sell if he had to. And it's an appreciating asset because of the types of cars he collects. And then, of course, you've got just your standard, what are you earning in a bank account, which right now doesn't exist because interest rates are historically low and banks are paying no money.
Yeah.
So each of those aspects we tackle, and then within those, it's what are you most interested in and comfortable with. And I think where people get lost is they look big picture, but they see small picture. They're trying to go big picture, but they see, I can invest in Snapchat or Facebook and make $1 million today. And that's really not how it works. It's educating yourself on what you are investing in and how you want to invest your money, and then being able to take an educated approach on when to buy and sell. And it's really a long-term game. And I think that's what ease of access to information has made it harder to play the long-term game. Would you agree?
Oh, totally. Yeah, most definitely. Yeah, it's the sort of, because it creates that fear of like, I must take action. I must do something. I must, where it's hard to ignore most definitely. And not to mention just the endorphin rush of transacting, the fear plus the like, I must sell Bitcoin now because it went up, or I must
exactly.
do
This is why our investment portfolios are taking a hit, because everything is reactionary now. 20 years ago, you didn't have Google telling you that somebody just sold something and made $1.5 million on it. You didn't have that. And so investments and businesses and your stock portfolio was based on what the quarterly reports were for that company and what they were saying their gross sales were and how they were growing. And now everything is behavioral finance 101, which is reactionary. It's not education. And that is one of the things that we really hone on with the players we work with and the clients we have is don't make a decision because somebody posted something on a social media site and said it's going to happen.
Right.
And that's where people get their information now. And so part of my job as an educator is to say, make sure your sources are correct. Understand what you're actually interested in investing in, and then proceed. So we could even take this to real estate and deep dive an example if you wanted to.
Yeah, no, I mean, be curious because I think that for, the professional athlete or the NFL player, when if you, one in particular from Portland, got hooked up with a real estate guy, which was, not, it was good, right? But the point is that they end up bumping into people and they develop relationships with people who say, hey, I've got this great deal, right? Like, you want to get in on this thing. Yeah. And so, I'm curious to see like how you as an educator are sort of coaching them through that process. Because it's the same thing. It's going back. It's the word discipline, right? Like, okay, pump the brakes. I know you're excited. We got to slow down a little bit here and think through this. And I'm assuming more often than not, much like we talk about here. I mean, I'm trying to help people go from ignorant to enlightened. I'm not calling people dumb. I'm just saying we're all ignorant. Ignorance is sort of that gets in our way. I mean, we have to do things to teach ourselves and it's education to learn so that we're not ignorant to things. So we're not doing reactionary, like I saw so-and-so doing this, so I need to go. Someone else started a restaurant, so I need to start a restaurant. Someone else partnered with so-and-so, I need to do that. It's like, well, I don't know. Maybe you do, maybe you don't, but do you know anything about it? Well, not really.
Do you know anything about it? Yes. Yeah. Okay, so I have to tell you the story because you totally just sparked it, Lance, and I love it. I had a player come to me 3 years ago, and this is kind of the business side of investing. So we're going to flip the script a little bit. He came to me and said, hey, Hill, my brother wants to open a barber shop. And I said, great. I said, tell me a little bit about that. He goes, well, he just left college and he just wants to cut hair. I said, well, does he have his license? And he said, no. I said, has he ever run a business? No. Does he have a business degree? No. Well, how much money does he want? He wants $500,000 to do it. And I said, all right, let's just pencil this out. Let's just think about this for a second. And he said, no, it sounds like a great idea. And I said, take it all the way back for me, E. And he said, all right. I said, your brother doesn't know how to cut hair. He's never run a business. He doesn't know what a P&L is. And he just left school. And you want to give him $500,000 to go open a barbershop. And he was like, he actually sat there for a minute. He said, okay, nope, get it. You have a point. What do I do? And I said, if this is something you two want to do, play the long game. Make him go work in a barbershop for a year. Get a client base. Understand how that works. Get a mentor, right? And so what his brother ended up doing, and we're now 3 years out of this situation, so I can actually say this whole thing came to fruition.
Yeah.
Start getting your education with your brother. So his brother went and got his barber's license. He started working at a shop. He ended up mentoring under a guy that was about 20 years older than him and learned how the shop was actually run. And then they were, both my brothers, my client and his brother, were going to open a barbershop jointly, although my player was going to put up all the money. And I said, instead of opening it jointly, he needs to have skin in the game too. He needs to save, and then you guys can go 50-50. And I said, and ask your FA, because I'm not an FA, I'm just giving you all the tools, but ask your FA, get a second opinion.
Yeah.
And he said, okay. So what ended up happening about a year later is brother got his license, mentored. He actually became such good friends with the person he was mentoring under that they decided to open a second shop about 20 miles away with that person as a partner. So they went in a third, and a third. And he helped them completely set it up. Now, this all happened way prior to COVID. And so when COVID hit, what they were actually able to do was shut down one of the stores, still maintain the first one, and they didn't lose any money.
Yeah.
And basically what it came down to, as you were saying, and this is why I said, oh my gosh, you sparked it. Ignorance is not us being stupid. We do not get this education. We don't know what we don't know. And so in order for us to become enlightened, we have to learn. And that takes people and mentors that know the stuff to teach us. And so when I'm working with these young athletes who are brilliant at their trade is sports. Yeah. They've never been introduced to the topics of finance, ever. And so when they come and they think it's a great idea, they have good intentions. They don't realize what the implications of getting to those intentions would be. And so to watch these two young men, they were 22 when I met them, they're now almost 26, go through this together and grow a business. They're now actually so interested in the education side of money. One of them went back to school and started getting his certification and his master's in entrepreneurship because he wants to understand how it all works. And I think once you get a taste of education and someone guides you down the right path, you want more.
Yep.
And that's one story. And now not only does he have a company, he has a source of income and a cash flow that he's now going to take, reinvest in other things to improve his cash flow.
Yeah, exactly. Yeah, it's a beautiful thing, and that's why I always say is like it's the same thing. I mean, you've got these people who once again have accumulated wealth over time.
Yes.
That oftentimes started a widget business, whatever, barbershop. It doesn't matter. They do that, but that's the point. Is that to be good at anything, to get to the point where you can make a living at it, whether it's you're an elite athlete, you've God-given ability, right? And you've been able to take care of yourself and develop the skills and, all those sorts of things. It's all the same. Like at the end of the day, it requires this very concentrated effort of time, over time. And invariably, it often means that at the expense of other things, right?
Absolutely.
I mean, so what we see a lot, right, is that people are like they were in some business and they ended up making a bunch of money, and now they're trying to figure out, well, how do I invest into real estate as an example? And that's why I always say, like, okay, it doesn't matter if it's real estate or it's anything. Like, we're all investors, and it's just, okay, everybody's an investor. We have to think that way, right? We can't sit there and look and go, Warren Buffett, oh my God, he's just a god and he knows all this stuff. It's like Warren Buffett puts his pants on one leg at a time like the rest of us, right? And when you think and look at what he does and how he does what he does, it's vanilla. There's nothing complicated to what he does. He says, what do I know? What do I understand? And based upon the information I've gathered, what do I think is going to happen? Does that make sense? Those sorts of things. If I can buy it at this, it's like, I can love Burlington Northern Railroad, but if someone wants to sell me Burlington Northern Railroad at X price, based upon my own analysis, he's going to say, I'm not willing to buy there. Now, if Burlington Northern calls me up and says, I'm willing to sell you at some different price that's lower, then he's going to go, well, I can get behind that. I feel like there's value to be made, right? And so it's with everything. It was a barbershop, it's Burlington Northern, or it's some multifamily syndication, or a rental house, or a vacation home, or whatever. Yeah, I mean, you're an investor, so it's an investment. If it's an asset, and once again, you can buy cars that depreciate, and you can buy cars that appreciate. Right? There's a big difference,
Huge.
There's a huge difference, right? And so to buy the ones that depreciate is pretty easy. As long as your money's green and you can send it to them, they'll take it, and you drive it off the lot, and it's worth 20% less than it was 5 minutes before that, right? So
exactly.
Just to tell the difference and figure out the difference, it requires educating yourself and thinking through that economics and finance and all those sorts of things. So to be good at it requires you to do that. And I think that you have to learn. And I think that when you look at what I think I think what's happening in front of our eyes, right, is that the generation before, and the generation certainly before that, they went and worked someplace, they earned a pension. So basically where they worked was it was just set it and forget it for them, right? Like,
exactly.
You worked here this many years, then we'll take care of you, after you retire. And then in whatever the 70s, when they sort of switched to the IRAs and, the 401ks, 1974, right? Then all of a sudden it was like, okay, you know what? Not so much of that anymore. We're going to phase that out, and now you're on your own. And, investment advisors and financial advisors proliferated, right? And said, we're here and we're going to, we've been educated, we'll do it for you. Oh, great, because I don't know anything about it. And we've entrusted those people for now, 2 or 3 decades. And, and now I think what people have realized is like, oh no, we're coming up short.
Yeah.
Like, it's not penciling out. Now, hey, not to pick on all those guys. I mean, we had obviously the global financial crisis and all those things. But once again, there's always some event like that over someone's lifetime. You have to count on you're gonna have to live through 2 or 3 of those things.
Yeah.
Right. And that's the long game. and the way that you have to look at it. But nonetheless, I think most people completely abdicated their own financial, their own financial well-being to people that they hardly knew,
Oh, I
right?
think
Who
people
did not
do.
have the same aligned incentives, right? And
Yeah.
now they're going, oh crap, we need to learn quick, right? Like we need to figure this out. And it seems like that's kind of what we're in the midst of, is people are going, I need to learn this stuff. Like I've got to take control of it. I can't just abdicate it to somebody else. Would you agree?
I would agree. And I think a portion of that is ease of access to information again, because
Yeah.
now we can learn. It didn't use you used to have to go to school to learn this stuff. Now you can learn from the best, and you can do it online for free. It's amazing. It's incredible.
Yeah.
Which 10 years ago didn't exist even. When I left college, podcasts weren't a thing.
Yeah.
You have to go to Barnes and Noble to Borders. Actually, do you remember Borders? Oh, Borders.
I remember Borders. I love Borders, and I love Barnes and Noble. Yeah.
I wish it was still open. You have to go to Borders, you have to go to the finance section, and then you have to find the book you're interested in. And now I can type into Google anything I want, and I'm going to have 100,000 pages of references.
Yeah.
And so the ease of information has also given us the push that we need to know about our money. But it also has led to a lot of financial literacy is up, but good financial literacy practices are not. And so it's finding the right information and filtering out what is wrong and what is right and what works for you, because not every program works for every person. And so that is the piece. I completely agree with you. People are now going, oh, I need to know my numbers. I need to know what I'm doing. But I also need to be educated in the decisions I make. And you mentioned Warren Buffett. Everyone always asks what Warren Buffett invests in, but nobody asks what books he reads. What books does Warren Buffett read? Go read them. I mean, he has a whole list. And I heard a lot of them. And the information that you find in those books are very quality, because it teaches you how to analyze a stock. It teaches you how to analyze a company, how he has chosen what he thinks is of value. Now, I don't always agree, and I'm sure you don't either, because value is also based on the person and what they think is going to happen. And we all have different perspectives. So that's why the stock market is what it is. But yes, I completely agree. I think people are so much more aware now, and they're trying very hard to learn everything that they can to better their financial wellness.
Yeah, I agree. And that's why for me, as I call it, that's where the risk comes in, right? So to me, it's like I said, you can do all of this learning and educating, and the moment of truth is when you say, based on the information I've consumed, what do I think is going to happen? Because no one has a crystal ball. No one knows. And what happens is that it's just, I know I'm stating the obvious here, but it's just like, I think it's important to like be, okay, if someone's saying that they're going to generate a 15% annualized rate of return or an IRR on some investment based upon these projections, they're making assumptions about what will happen in the future.
Always.
Right? Like no matter what it is, someone's saying, we're projecting that we think that this is going to happen, it will generate these kinds of returns and whatever. That's their version of it. Our job as investors, once again, we're all investors, is to say, what were those assumptions, and do I believe that those things, like what's the likelihood of them occurring, right? And all those sorts of things. And what could go wrong? Could there be a pandemic? Could there be a hurricane? Could there be a stock bubble, housing bubble, whatever? But that's the part. Who knows? And so that's what, the great investors have good intuition after they've done all of that. They're good at sort of making those sorts of decisions. And that's why I think you have the diversified portfolio theory. Portfolio theory is because what people say is that it's too much. Like I cannot know enough in my ability, because what I just said, you could take the same snippet. It sounds a lot like gambling.
Yeah, a little bit, yeah.
Right? You know what I mean? I think the Suns are going to win 9 points tonight, right? Because football's going to be back, right? And they're at home and they're whatever. And, based on the information I have, I think this is going to happen, right? And so it just, but that's what we're doing. So anytime someone says they're going to generate some crazy return, the higher the number, then you have to intuitively say, well, that must mean that there's commensurate risk being taken. And our job as investors to figure out, do I believe that I'm being appropriately compensated for the risk? Because even if it's a high number, you still have to ask yourself, am I being compensated enough? Who knows, right? And that's when you were talking about cash, like have my money sit in a bank account. and inflation's at 3% and I'm earning 0. Not so good. So is cash safe? I mean, I know it's hard to say, it's hard to swallow. Doesn't sound like it. It sounds to me like not a very good deal. Like I'm going to, the cost of it's 3% and I'm getting 0. I better figure out how can I put it into something that's getting closer to
3%, yeah.
right?
At least matching inflation.
Yeah, exactly.
Yep.
So it's just it's not easy. If it was easy, then everyone would do the right thing. But that's the world we live in.
Yep.
And therefore, thinking about these things, building a diversified portfolio. Maybe you can speak to that then. Like, great, you love barbershops, great, you love exotic cars, but we can't put everything into that.
Right. And what does your mix look like? Because a diversified portfolio is a little bit of everything. So, and when I say a little bit of everything, I'm talking about stocks, mutual funds, bonds, real estate holdings, alternative investments. And alternative investments can be a big category or a small category based on your level of risk. And any financial advisor that you talk to is going to tell you that there are 3 main risk models: low, medium, and high. What do you want? And you were talking about, let's use your 15% annual rate of return. 15% is a high number. If someone's earning 15% or being guaranteed 15%, which you can never guarantee, so if anyone ever tells you you're guaranteed 15%, run. You're probably in a higher risk diversification of your portfolio. You're probably in a lot more stocks, less bonds, maybe a little bit more alternative investments, because what you're doing is you're putting money into companies and or things that are saying, hey, we might be startups, or we might be moving into third world countries, and we're going to develop something out there which is risky. So where are they invested? Are they a foreign entity or a domestic entity? All of those things factor into a diversified portfolio. And then in addition to that, and I'm going to hit real estate because I think it's so key, we're in the most unique decade of real estate we've ever been in.
Yeah.
But absolutely. So anyone who's been invested in real estate right now is like, screw the diversified portfolio. I don't even want to think about that, because everyone's been impacted by real estate differently. But it is a key component in a diversified portfolio. So if you have all your stuff in one thing, you're not doing yourself a service. Because if that one thing fails, you've lost your portfolio.
Yeah, that's right. Because real estate, it cycles. Like, we know that for fact. Has this cycle went longer? Yeah, it has, because the last cycle went deeper into the deep freeze. And it's not all that surprising. Of course, hindsight is 2020. It's sort of like, oh yeah, that's what happened.
I wish I would have bought in 2009.
Yeah, exactly. Yeah. But at that time, people were like, you buying real estate? What, you crazy? You out of your mind?
Exactly.
Right? And now it's like people get into it late. And I mean, once again, none of us know. But either way, if it's all in real estate, it's going to cycle. Well, if it happens that you once again have a life event or something that occurs, well, it happens to be down. Not so fun. Now, do you have another 7 years or 8 years to wait for it to rebound? Maybe not. Probably not.
Where are you in the cycle? How old are you? When did you start investing? All those things factor into your portfolio as well.
That's right. I mean, that's why it makes sense for young athletes, right, to put a disproportionate. I mean, once again, it can make it. It's easy to understand why putting more into VC, venture or private equity. Those, once again, those are growth investments.
And they're heavier risk. They come with
heavier risk. That's exactly right. Private equity is pretty easy to figure out. They leverage the crap out of most of the stuff they buy. They go and borrow a bunch of cheap money, and and they put it in there, and hey, the bank comes first. And so it's if we're and that's the sort of thing, is understanding that it's fun to say private equity is amazing. Like, I want to get in. I got into this private equity fund. It's super exclusive, or what? Okay, great, but you're at the same time, I just heard you a day ago railing on someone who was over-levered in a real estate deal at 80% loan to value. It's like, do you even know what you're talking about? Like, do you realize that private equity guys use more leverage than anybody, right? Like, oh, I didn't realize that. It just sounded cool and sexy. Like, okay, like.
That's the issue. Yeah, that's where people get stuck. It sounds sexy, so they buy it, and then they end up losing. And it's because, again, ease of access, everyone's instant gratification, and the long-term game isn't the focus. People aren't taking the time to research the company or the industry. I mean, private equity companies leverage, let's use manufacturing. That's a great example of a private equity fund. They'll pull 25 manufacturing companies in, and only 4 or 5 of them will succeed. But that 4 or 5, if they do succeed, will make that fund worth something. But it doesn't happen every time.
Yeah, that's right. Yeah, and they acquired those. They acquired all those with borrowed money at 2% or 3% or whatever, and that it's just, once again, it's understanding finance, it's understanding economics, supply and demand. To your point, these days we don't. I didn't even. I mean, I went to college a very brief time, realized like, wow, it's too much fun, and decided that's expensive. I can do that without being there. I was a college guy, but it doesn't mean that I don't know, because for me, I'm like, same thing. I can go to Barnes and Noble. I can just pick the books up. I love learning. I love learning just to learn the things. I don't care if you give me a piece of paper or not. The point is, we all have access to it now, right? And that's how you should approach things. Is you're going to get into something, you want you want the return, you've accumulated some assets, you want to invest. Step one is teach yourself, educate it. That's why I say, like, I have more multifamily sort of operators on as a proportion of anything. And a lot of it is just because I believe that multifamily is easier to get your mind wrapped around than some of these other property types and some of these other strategies. It makes sense.
Tangible. People can see it. It's something that's there. It's not out in the cosmos.
Yeah, you've probably lived in an apartment. You understand, and that's why it's important, because it's like, don't jump in and be like, I'm in self-storage, I'm in industrial, I'm in office, I'm in every deal. It's like, well, maybe, but just start, like, figure out how multifamily works, right? And start there, and then you can start looking at self-storage or mobile home parks or something else.
No shame in
Either way,
starting
same
small
process.
and learning, right?
Yeah,
No shame in starting small and learning, and then propelling yourself through. Start small, buy a four-door unit, or excuse me, 4-unit complex, and then sit on it for a year or two. Sell it, upgrade to an 8-unit complex, right, because it's not like you can't just go to a 150-unit multifamily property just like that. Good freaking luck. Start small, do it at 30s is a great age to start. Accumulate wealth, and over 10 years, sell 5 properties and continue upgrading. And by the time you're done, if you do it right, and the market doesn't fully collapse, right? I mean, life happens, we know. You've done all the right things to understand the industry. So now you can move into self-storage or office or commercial or industrial, or maybe you get out of real estate altogether and you start a business of some kind that has an additional stream of income outside of your investment property. So yeah, I totally agree.
Yeah, that's right. So I'm curious, like, is like this sort of conversation then, especially with the athletes, right, who do have short shelf lives, have you found that sort of you're having these sorts of conversations and then they realize, like, oh, yes, I need to start today while I'm playing, and I need to, or do you still meet resistance, or like, yeah, I'll get to it later?
I would say maybe 10 years ago I had more resistance, but now with how much information is available, and the guys that are coming in, these young men, they know there's a problem with money in athletes. They know that it's a shelf life. They know that it's not going to last forever. They have to make 3 years of income last 50. They get that now. And so the question now becomes, how do I live well while I play, but invest enough money that I can create generational wealth? I get so much feedback on what we're teaching, because we're really teaching what can you do if you do this right with the right team, if you invest and diversify correctly with the right team, and even if you only earn 5% a year on average, what could your pot look like? And they're starting to see I would say the last 3 years, my guys are coming to me and saying, hey, I have an opportunity for this or this or this. I ran it by my FA, but before I tell you what they said, what's your answer? And so they're asking myself and our coaches, just from an educational standpoint, we'll research a company with them. We'll go through a series of questions and say, does it make sense? And if they don't come to the answer we come to, we'll give them our reasoning. But we'll also say, you've got to talk to your FA, because our job is not to advise on an investment. It's just to give them education. So I'll ask a billion questions, but I won't answer any of them. And they go, well, can I get an answer? I'm like, you have to find the answer, because I can't sway you. But yes, it is. We're being met with a need to learn. We're finding that these young guys are ready to learn, and that for me has been the most rewarding piece of what we do.
Yeah, no, and I agree. And that's how I sell whatever. I'm just like, I just think that teaching people and educating, it just always has to come first. That doesn't really matter what it is. It's at the end of the day, pushing things on people, and this is what I tell people when they're trying to raise the capital. I'm like, I think you got it all wrong. Like you want to skip to the, hey, give me your money. And I understand that, right? Like, hey, you've got a closing date, you need to raise some capital or whatever, but it just doesn't work, man. Like it just doesn't work. Like someone just comes to me like, hey, hits me up like, I need 100 grand. Like, here's this investment. It's the world's greatest thing. I mean, I'm immediately going like, put the brakes on. Like,
I need a
no,
breath
no.
and I need about 3 months and I'll get back to you.
Yeah, it's like, okay, but if someone meets me where it's like, hey, let me tell you about, how you can invest in, exotic cars or whatever, and they're pretty like, I mean, if you start by teaching me what it is, and then you happen to have like, hey, I've got this partnership that's buying exotic cars and you can invest in it, whatever. Well, then my willingness and openness, because one, I'm not ignorant anymore. I actually understand. And even if you were the guy who taught me, who's now trying to sell me, I can get my mind wrapped around that. But it's just,
Absolutely.
it's the education piece is so huge because it creates that empowerment for them to feel good about their decisions. But before I let you go, one thing I wanted to ask you, I know this is a great conversation, but
Yeah.
what's your take on this, the name, image, and likeness? 'Cause that's now happening, which I think it should, because once again the NCAA has made so much money off of these athletes, but it does come to some of this. That means that some of these guys are going to be making. I know that right now a lot of the universities now are pitching their recruits on specifically how they're going to help them make a bunch of money, basically. What's your take on that? Because it does seem like education's going to need to be a big component of that. Because it was one thing for guys that are getting all this money at 22, and we see this in the NBA. That's been a big problem. It was, I mean, more so 15 years ago, because they were so young. Like they came right out of high school and they were really, really young. But now that means in college now, with football in particular, they're going to have some more money sooner than they did. So what's your take on that?
I'm 50-50 on it, if I'm being honest. There's a lot of development that happens in college. And when I was in college and I was watching some of my friends who were on the football team on scholarship, some of them were really well-known players at Oregon State University, where I went to school. They would get a scholarship check and it would be gone. And that's fine, because it's, the scholarship check and it's $1,500. It wasn't the end of the world. It's tax-free money, right? Well, now what you're doing is you're adding a layer of complexity to the college experience. And what I mean by that is any money that's being paid to these guys for name, image, and likeness is taxable income. So now they are having to enter into the real world a little faster, which is fine. Everyone needs to understand how taxes work. But if you're going to pay an 18, 19-year-old guy who could potentially be the Heisman $1 million a year, I think it should be mandated that anyone whose name, image, and likeness is being used has some sort of budgeting, compound interest, and credit counseling immediately, because there's so much potential for them to go wrong or not understand how taxes work and overspend and then start owing money the next year. There's a lot more potential for error. That's my bad side. That's my downside. That's my concern for these young men and women. Yeah. Because in the event somebody doesn't do them a service and they don't know how to fill out a W-4, or their parents don't know how to fill out a W-4, and they receive $1 million and they claim exempt and they get $1 million in hand and no one takes taxes out, and they get a bill for $500,000 the next year and they don't have that money, what are they going to do? I'm concerned about that, right? Because I don't know what the NCAA has put into place for that and how to protect these players, these young athletes. And they're also student athletes. They're there to learn too. So if you are going to provide that kind of money, you've got to back it with the education. But on the flip side, I love that they can and have the ability as entertainers and athletes, because they are entertainers. They are now celebrities. This is part of that world, and that is great. They now can capitalize on that. And I love that they can do that, because that is exactly what the American dream is built on. Being able to take a situation and make it your own, and be able to earn money on something that you've done well and you've exceeded at. And from that perspective, I'm like, yes, let's pay them. So the educator in me is nervous, because I do not want any of them to fail. But the capitalist in me is excited, because they're able to now improve their financial picture and potentially impact communities and people and everyone around them. So, it's 50-50 for me. I'm literally on the fence. Some days I'm upset about it, some days I'm happy about it.
Yeah. No, yeah, I agree. It's interesting. And most, sports talk radio or ESPN, they're not sort of ever bringing that point up about, hey, great, now they got paid, and the taxes, and all these other things that. And once again, it's not to throw a wet blanket on it. To your point, it's just to say that it. Yeah, they deserve it. It is what it is, and I get all those things. But at the end of the day, there are potential consequences that, because once again, we've seen it. Maurice Clarett from the Ohio State Buckeyes. I mean, a lot of these guys, they blow out their knee, or things happen, and all of a sudden, like you said, it's like they thought they're going to have that income there and pay the tax bill or whatever, and they don't.
And it didn't come.
But yeah, I think the theme of our whole conversation here, right, is that how important education is, and being educated, taking it upon yourself to educate yourself so that you can then execute a plan and be disciplined, and and do things the way that, or at least closer to the way they should be done, and without, because you hear everyone is like, oh, I made my first syndication, I lost 50 grand. Like, I don't know how many times I've heard that, like, yeah, my first foray into it, I lost everything. I'm just like,
I hear it all the time.
Yeah, how did you, like, but like, I was an idiot. Of course they don't want to talk about it, but I'm like, it's just, okay, that drives me crazy, because it seems completely avoidable. But but anyway, that's why we do this podcast 3 times a week. It's why you do what you do. So with that said, where can people learn more about what you're up to, and where can I get more resources on that?
Yeah, so you can find us at financialfootwork.com, or on Instagram or Facebook at Financial Footwork. So super simple. And we're an education-based company. We provide everything fundamental, from home buying classes to credit books to basic budgeting courses, and really our entire platform is based on education and just teaching people the basics of finance.
Cool. Awesome. Well, thanks so much for your time. I really, really appreciate it.
Thank you so much for having me.